Today, we're building something completely game-changing together. We are literally going to construct your financial house, a step-by-step blueprint designed to absolutely eliminate your money stress and build serious long-term wealth. And we aren't just relying on opinions here. We're leveraging hard institutional data from Vanguard, Voya, Financial, and legendary investors to show you exactly how to pull this off. Okay, let's dive into this. 7.3 hours. That is a staggering number. According to some deep research from Vanguard, people who don't have emergency savings spend 7.3 hours every single week just agonizing over their finances. Think about that. That is nearly an entire workday every single week lost to pure financial anxiety. We have to fix that. And today, we're gonna do exactly that. So here is our ultimate blueprint to buy back your time and peace of mind. First, we'll cover the financial stress epidemic. Second, your emergency savings buffer. Third, mastering asset allocation. Fourth, Buffett's index fund strategy. And finally, the practical steps to get you started. All right, section 1, the financial stress epidemic and the hidden costs of those money worries. You know, financial stress doesn't just drain your wallet. It actively sabotages your productivity, your focus, and your overall well-being. Vanguard's research illustrates this perfectly. Working folks without emergency savings spend an average of 6.1 hours per week distracted by financial stress while actually on the job. Now compare that to just 1.5 hours for those who have a savings buffer of at least $2,000. Lacking a financial safety net literally equates to losing almost a full workday every single week just to distraction and worry. And honestly, it just gets worse over time if you ignore it. A massive 51% of clients without emergency savings reported that their financial stress actively increased year over year. This really establishes the core problem we need to solve today. Because without a baseline safety net, that stress doesn't just sit there, it compounds. Moving on to section 2, your emergency savings buffer. This is all about laying the foundation. Now, what's really interesting here is the stark psychological contrast. It's just like building a real house, right? If you don't pour a solid foundation, whatever you build on top of it is eventually going to crack. Having $0 in emergency savings means high stress and constant everyday worry. But simply crossing that threshold to just $2,000 gives you a 21% higher financial well-being score. It literally buys you back 3.6 hours of your life every week that you'd otherwise spend panicking. Okay, this next finding is absolutely mind-blowing. Vanguard's regression analysis revealed that a $2,000 savings buffer provides the exact same financial well-being boost as having $1 million in financial assets. Let that sink in for a second. You don't need to be a millionaire to drastically drop your mental burden. You just need to take that small, entirely achievable step of laying down your foundation. Next up is section 3, mastering asset allocation. Let's build the framing of your house. Pulling from Voya Financial's research, let's clearly define what this means. Asset allocation is simply finding that sweet spot, the right balance between higher and lower risk investments by dividing your portfolio among different asset classes. And here is the real secret. How you divide your investments across these broad categories is actually way more important than the specific individual investments you pick. And this brilliantly illustrates the ultimate goal here: becoming a calm, confident investor. By properly matching your risk tolerance to your time horizon, you totally remove the panic from investing. You aren't just guessing out there, you have a structural plan that balances your future needs with your ability to weather the market storms of today. So what exactly are these asset classes we're using to build our frame? According to Voya's modeling, a typical portfolio uses 3 main building blocks. First, stocks, or equity, which give you the highest historical returns, but, they come with the highest volatility. Second, bonds, which act as income. These are basically loans paying interest and are generally much less risky than stocks. And third, money market, or cash, which are short-term debt instruments that track interest rates and give you pure stability. Now, if you're wondering, does this actually matter? Check out this number, 91.5%. A landmark Brimson study proved that a staggering 91.5% of your portfolio's long-term performance is determined simply by your asset allocation decisions. It's not determined by timing the market, and it's definitely not about picking the next hot stock. It's just about how you divide your money between stocks, bonds, and cash. We definitely need to clarify one vital difference here to bust a super common investing myth. Asset allocation is dividing your money across completely different asset classes, like mixing stocks and bonds. Diversification, on the other hand, is just spreading your dollars around, like maybe buying 20 different technology stocks. Diversification is great, sure, but if the whole tech sector crashes, you still lose. Proper asset allocation protects you by ensuring you aren't putting all your eggs in a single asset class basket. All right, Section 4, Buffett's Index Fund Strategy. Time to put the roof on and finish the interior. So the crucial point here comes from an analysis by MXC News, summarized perfectly by one of the absolute greatest investors of all time. Warren Buffett gave this famous, dead simple instruction for non-professional trustees. He said, put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He strongly argues that this straightforward approach serves most people way better than trying to pick active managers. So Warren Buffett's default allocation is a 90-10 split. That's 90% in large U.S. companies via the S&P 500 and a 10% buffer in short-term bonds. This is a brilliant, illustrative, and conservative default for hands-off investors who have a long time horizon before they actually need to touch the money. It's clean, it's simple, and it's incredibly effective. And here is the rock-solid evidence backing up Buffett's strategy. Independent industry scorecards continually prove that the majority of active managers, the Wall Street pros paid huge fees to try and beat the market, actually underperform their passive index benchmarks when you factor in their fees. High fees and frequent trading turnover act as a massive drag on your long-term returns. And that right there is exactly why low-cost indexing almost always wins out over the decades. Which brings us to Section 5, Practical Steps to Start. Let's actually execute this blueprint. Let's move to and see how this all builds into a super actionable checklist based on the MXC guide. Step 1, pick a benchmark like the S&P 500 or total market index and decide if you want an ETF or a mutual fund. Step 2, compare the fees. Always look for the lowest expense ratio. Step 3, check your tax placement, deciding if the fund belongs in a taxable account or an IRA. Step 4, set your allocation based on your personal risk tolerance and automate your contributions. And finally, Step 5, rebalance occasionally just to minimize turnover. I really want to emphasize that automation part. You absolutely have to automate to take human emotion completely out of the equation. Just use a simple rule to rebalance your portfolio, like checking it once a year on your birthday, or rebalancing only if your allocation drifts by more than 5%. These simple rules are going to prevent emotional trading when the market panics, and they preserve your tax efficiency by keeping your trading costs super low. Well, we've looked at the institutional data, the strategy, and the exact steps. So what does this all mean for you right now? I leave you with this final question. What is the very first brick you are going to lay today to build your financial house? Will you secure that first $2,000 to buy back your peace of mind? Or will you automate your first index fund contribution? Take just one step today to buy back your time, eliminate your stress, and secure your wealth. Thanks for joining me on this explainer, and happy building.